Welcome, friends, to Alpha Beta Soup. I'm TXMC. Feels good to be back in the chair. Haven't made a video since December, and my job was really hectic for the last few months, and I unfortunately just didn't feel comfortable committing to making videos at the same level of quality I had before. After 2022 had a really dicey year for the markets, things at my company started looking a little rough, and so my day job got a lot more stressful. My boss got fired in Q4 last year with no warning. My responsibilities grew by a lot. I wasn't being paid anymore, and I felt like I was set up to fail. I tweeted about it a lot during that process. And lo and behold, a couple weeks ago, I finally got laid off. So now I have some time available to put back towards making videos on this channel while I figure out my next steps. So here we are. I'm sorry you guys had to wait so long, but I just had to rearrange my priorities for a few months until I figured things out. Ideally, I could make money without having to go back to some boring desk job somewhere, but we'll have to figure that out over the next few weeks and months. If you are listening to this channel for the first time, I am just a guy on the internet. I do not have a background in finance, so please take everything I say with a grain of salt. These are my opinions only, and they do not construe advice. And what I'd like to do today is just kind of talk about the market from a high level. I don't want to get super into the weeds because we haven't talked in a few months, and there are a lot of things to dive into and to pick apart, and we can save that for upcoming videos. And over the next few, we will peel this onion apart. But for now, we need to start with the rind. We need to start from the beginning, look at a 30,000 foot view, and kind of get a sense of what's been going on the last couple of months, where the market is, what are the probabilities going forward, what are factors playing into that. And let's start with Bitcoin. So right here, we got Bitcoin on the screen. It's a 3-day chart, and I've marked out the key levels over the last year and a half, and I call them Bitcoin traumas. And each one of these marked a really significant event for the space, not just Bitcoin, but crypto at large. And you can see we've been slowly climbing back above each of these events. The FTX lows were not revisited but one time. The lows from when Three Arrows Capital collapsed last summer were finally surmounted in a strong way, though we haven't come back for a retest of that yet. Maybe we will, we'll have to see. And after a little bit of resistance and rejecting from it a couple of times, we finally broke through the Luna wick from when Terra Luna collapsed last May. And we're coming back down to retest it here today on the back of some news about CZ and Binance being sued by the SEC for selling unlawful, unregistered securities. And as far as Bitcoiners are concerned and people in the crypto space, crypto natives, a lot of those folks have the assumption that the 4-year cycles are still intact, that the bottom is in from the FTX lows, and that this is the beginning of the next generation bull market, right? We've got the halving next year in 2024. Usually there's some positive price action into the halving, and then we get a bull run. And that's the common wisdom these days, that we'll get another one of those. And if we think back through Bitcoin's life, all the way back to the beginning in 2009, it has existed in an entire economic expansion. Expansion started when the great financial crisis bottomed in March 2009. From that point until maybe right around now, we've been in a prolific economic expansion with a couple of interruptions, some bigger than others. 2011, things slowed down a little bit. 2015-16, things slowed down a little bit. 2018, we had a really ugly end of the year, in equities particularly. And then, of course, there was COVID, the COVID response, which did register as a recession. But since it was such an artificial shock, it didn't really produce the same kind of end to the business cycle that you would normally see at the end of an expansion. We didn't get that. All the zombie companies stayed zombies. A lot of people went right back to work a few months later, and the economy began growing within a quarter of the recession being over. But as we stand here today in 2023, there is a high risk that we're near the end of this expansion. And it seems like we have a Federal Reserve that is intent on engineering that outcome. The Fed still talks about achieving a soft landing, which is a slowdown in the economy without a bunch of people losing their jobs. And they still think that they can make that happen and make inflation come down without the economy slowing down enough that a bunch of people go out of work and we have what would be considered a real recession. But I am not so optimistic about that outcome. outcome. We'll unpack that today and in subsequent videos because there's actually a lot to say about that. But the point I want to get to as it relates to Bitcoin is that Bitcoin's life so far for 12, 13 years has been in an economic expansion up into today, up into this very day now. We are still in an expansion. Now, we may be on the precipice of a contraction, but it hasn't manifested in the data yet in full. So we still have to kind of wait and watch closely. But if the economy does slow down, if we have some people lose their jobs later this year or early next year, which is a considerable possibility, I think we have to be open to the idea that Bitcoin's 4-year cycles could be under threat and that it may print a new fractal that breaks people's prior expectations. And for the case of Bitcoin, that break would be a takeout of these lows. Now, if we look at on-chain, we look at Bitcoin on-chain, it says we bottomed, right? And so for now, until the market is given a clear invalidation in the form of maybe a massive spike in unemployment, in jobless claims, something else falling to pieces, until we get something like that, the market is moving forward, the crypto market, Bitcoin specifically, as if the bottom is in and the cycles are going ahead. If you look at MVRV, which is one of the most popular on-chain indicators, it's a ratio between the market cap here in black and the realized cap here in orange, which is like the network's cost basis. It's the price at which every coin in the active supply last transacted on chain. And when this ratio gets really far apart, when these two lines are really far apart, MVRV is very high. When price falls below the realized cap, MVRV is less than 1. And that usually marks bottoms, right? If you look back through the cycles, whenever price has gotten below the realized cap, that's been the point of capitulation. And so we've gotten these little kisses down here in the trench on MVRV. We got another one in November. This is right around the time that FTX filed bankruptcy, like November 9th, November 10th. That was the kiss of the bottom on MVRV. So by this metric, the bottom is in, right? If we look at dormancy flow, this is another popular on-chain metric. This is a ratio between the market cap and age-weighted spending on-chain. Now, when we have a bull run and we're breaking into all-time highs and into price discovery, you have a lot of older coins being spent on-chain. Those are people who held through the bull run, through the bear market, and they're paying themselves for years of holding a volatile asset. They're paying themselves for being exposed to the market. And when you have price appreciating while that spending is going on, then dormancy flow remains elevated, as we saw throughout the 2017 bull run and even in some of these markets in the past. Now, in the prior bull run, we didn't see that huge blow off and sustained high level, but it did kiss its own little median value here, and then it broke down. And the lows for dormancy flow were like in June, July of last year, actually a few months before the bottom of price and before the bottom of MVRV. And in fact, it set a low that broke all the prior lows going back to the inception of price, which in a way kind of made this metric look super broken. But that was a few months ago. It has recovered. It's now back into the positive territory, and it is confluent with MVRV saying the bottom is in. Bitcoin itself recovering from the traumas of last year, starting to be more optimistic. But again, the question remains, a question that is not answered yet. Will the economy avoid capitulating long enough that Bitcoin's 4-year cycles can remain intact? We don't know the answer to that yet, and I remain open-minded to the possibility that we will see a fractal we've never seen before. If we go look at the S&P, we can see it has also been climbing this year, and in fact, it's now getting up into its retracement levels. Those of you who've watched my videos since far back in the beginning know that these retracements are very important to the direction of the market. Now, it's not about specifically the 618, specifically the 702. Really, it's a range. And I don't use the Fibonacci to make trades with. It is simply a confluent tool among many other tools. Some people make fun of the fibs. They don't think they're very useful. I think those people are not being pragmatic. They do help to tell part of the story. But like any indicator, just like RSI, like MACD, like volume itself, they can be misunderstood and in isolation, not necessarily useful. You need confluence across multiple tools. And where we are right now, we see a market moving up very strongly. It's now getting back up to the golden ratio fib at 618. And this whole range here up to about 4,500 is a danger zone. If price surmounted all of these levels and it got above 786, got away from it, back tested it and started to move higher, well, then we should be optimistic because the next target is up here. That's really the way to think about these things. It's rare to see an asset retrace 85% of its move and then just come all the way back down. Usually, most of the time, it runs out of steam in this area right in here. So that's what I'm watching for. We're there now. If we look at the Dow Jones has been at its 702 retracement since November. For half a year, it has been stymied by the 702 retracement level. Here, came back up, retested it, couldn't quite get there. Now at the 618. The Dow had this really strong move here in November and October last year when the rest of the market wasn't quite ready to do that, to join in. It got way out ahead of its skis, and it's just been kind of hanging in a stasis, and it's gone essentially nowhere since November. And these retraces have always been important. They've been important since the beginning of markets and price charts. In fact, there was a book written about it about 100 years ago. There was a man named Charles Dow who lived in the early 1900s, and he was a market analyst, and he used to publish a column in the Wall Street Journal giving his market outlook. And he's one of the early fathers of technical analysis and pattern recognition in the markets. He helped to define bull and bear cycles in the early stages of the Dow Jones in like 1910s, the 1920s. And then a book was written in 1932 called The Dow Theory by Robert Rea, and he helped to encapsulate all the ideas of Charles Dow from all of his writings from the years before, because he passed away right at the beginning of the Great Depression. He passed away. And he wrote back in the early 1900s, a secondary reaction is an important decline in a bull market or an advance in a bear market, usually 3 weeks to 3 months. And during this time, a price movement could retrace 33 to 66% of the primary change since the end of the last secondary reaction. Now, some of that's kind of flowery language. What he's really saying is prices can retrace 33 to 66% of the prior move. 66% is right here. It's the 66 fib. So these retracement levels have always been significant. That was written about the Dow Jones in the 1910s. Now, people commonly like to think that because the markets are digital now, because information travels so quickly, because we have algorithms and high frequency trading and all of that, that for some reason markets don't move in the same way, that they don't have the same kinds of expansions and contractions and relative moves to past moves. And that's simply not true. All it takes is a little bit of study on the chart itself to find out that we still have, in much the same way, the kind of fractal movements that we've seen in markets since the dawn of price charts. So that's why I find these retracement levels so interesting. And it's been a long time coming, but we are finally back up into them now. Now, granted, if we were to do that over here on Bitcoin, we would see that it has not even gotten to its 50% mark, which would actually be up here around 42,000. Now, maybe it makes its way up there, but as of right now, it's really taking its sweet time about it. And if we back up here, I deleted some of my drawings, we can really see that Bitcoin itself has been really just kind of range bound, right? Here's the Luna wick. We're coming back down to test it. Let me take that off my screen. And you can see we're just in this big range. Here's the top of the range. Here's the bottom of the range. Here's the midpoint. This is a quarter. This is 3/4. And we're just ping-ponging around inside this range here. In fact, even funnier, if we put this on a monthly chart and all I do is I box out December 2020. We're basically in the December 2020 price range for Bitcoin, right above the prior all-time highs, right below the bull run. We tested it here, nice little reaction. We dipped down below it for a bit. We came all the way up. You can see some reactions here at the midpoint. Turn off my magnet. And we came up here for a clean rejection. Look at the close. Look at the close on this candle right here. Like, that is some respect. And it's very close to our generational floor price level that we marked out. So there's more than one layer of confluence here. But big picture, Bitcoin's still range bound. It hasn't done anything. And until we actually see a confident move above this level, test it and move away, it's really hard to get confident about where this range is headed. Because I think that now that we've gone from one end of the range all the way to the top, that at the very least, we need to come back and test the middle as a springboard to moving higher. And that's why I think maybe it's realistic that at some point we get a retest of the 24-25 level, which is this Luna wick right here. Come down. We're at it now. Do we dip lower? Do we come down into this 23 range here? Do we come down and test this order block right here? Yet to be seen. That's more of a trader's perspective. But I really just wanted to show you how we're quite range bound when you think about this from a high time frame perspective. The monthly chart is so clean to look at. Coming back to equities for a minute, I wanted to talk about the leadership in the indices. So we've seen the indexes, mainly the S&P, the NASDAQ, pushing higher in dramatic fashion. But if we peel back the layers and we look at the leadership inside of the index, it's actually very thin. The top 8 or 10 stocks in the S&P 500 are responsible for essentially all of the gains in the S&P in 2023. And the other 490 stocks at the rest of the index are essentially break even as a group. So what we're looking at right now is the NASDAQ QQQ over the equal weighted S&P. So it's not biased towards the larger companies in the index. Everything is weighted equally, all 500 companies. And if you look at the NASDAQ over that equal weighting, you can see how strong this rally has been. This is what it has looked like on the S&P right here. It's been a lot more kind of choppy, moving around. But if we look at it purely as tech companies versus the equal weighted index, you can see where the concentration has been. This is a ridiculous pump. For this particular asset class here, this is a 37% move relative to the equal weighted index. And there are people out here that think that this is bullish, that this is how bull markets begin, but that isn't really the case. Bull markets don't begin with an irrational hype concentrated in 5 or 6 mega cap tech stocks that are running on a new narrative, that narrative being AI. That isn't where bull runs typically begin. Doesn't mean it can't, it's just not typical. While we're on the topic of breadth, here's another view of breadth. So we're looking at the S&P. We've got a few moving averages here, 20, 50, 200. And let me close this box for less stuff on the screen. If we come down here and we look at these 3 lines, these lines are color coordinated with the moving averages above. This represents how many stocks in the S&P are above each one of these moving averages. So the blue is 20-day, yellow is 50-day, red is 200-day. So let's look at the 200-day. The first thing I really want to point out here is that in the prior rallies in November, December, and in February, we had much broader leadership than we are seeing right now on a long-term basis. We had more stocks above their 200-day moving average in December than we have today in June in the S&P 500, and price is 7-8% higher, depending on which candle you choose to start from. The index has gone up 8%, roughly 7%, and there are fewer stocks above their 200-day moving average, actually less than half of them as of right now. Let's look at the 50-day. Same exact story as the 200-day, almost identical, except for the fact that we got even larger dislocations, even more participation. Here, stocks above their 50-day moving averages. But if you go look over here, the market's continuing to climb higher, but you have stocks falling below their 50-day moving averages. Look, price is going up, breadth is going down. That is not a good sign, friends. And there are not enough people that pay attention to these metrics here. All they're looking at are top line numbers. They're looking at Nvidia's earnings report, and they're completely buying into the hype. And I am here to say I am selling the hype. I don't think AI is ready to do what people think it is. I think that this very much resembles the hype around the internet in 1999 and 2000. Now, we haven't developed a bubble to the scale of what we had in 99, 2000 isolated to the internet companies, right? We haven't done that with AI companies here today. It's more scant of a group. There's only a handful of them. However, the sentiment is very similar because the amount of hype that was built up around internet companies around 99, 2000, the expectations for what they were about to imminently deliver was far removed from what they were practically able to deliver. So the hype got far out ahead of reality. And as a result, the bubble popped in dramatic fashion. I think that AI is treading a similar, albeit more muted path. Now, Nvidia, Broadcom, Apple, Microsoft, they have been benefiting from this move, and they have been helping to lead the charge on things like tech over the equal weighted index. They are responsible for that kind of move. But again, when we look at breadth in the market, it doesn't look good. It looks quite unhealthy. And in fact, even just looking at the 20-day moving average, which is a much faster moving average, it's more than twice as fast as the 50. Even that, we are seeing low leadership relative to April when price was lower than it is today. So what that means is that as the index moves up, there are names inside of the index falling below their moving averages. They are selling off while people buy into a couple of names at the top of the list. One thing I want to go back to is another quote from the Dow Theory. And it talks about something that happened in 1930. There was a sharp move, and Charles Dow didn't believe that that was the beginning of a new bull market. And he touches on why. He says, some readers might ask why the secondary rally in the spring of 1930 did not indicate the termination of a bear market and the beginning of a new bull period. One answer is that any student of the averages, that's what he calls the Dow Jones, knows that bull markets do not begin with violent rallies. Moreover, a reaction recovering 25% or even 100% of the ground lost is not without precedent in the early stages of a primary bear movement. So what he's saying here is that it's even possible for the index to retrace much more of its original ground lost, maybe even touch the prior all-time high before descending down into a bear market. Some of you may recall that's exactly what Bitcoin did. Now, I'm not saying that that's what the S&P is about to do, but you have to stay open-minded here. There's a lot of misinformation going around on the internet today about how the S&P is now up 20% off of its lows. Let me pull up a different chart. We'll look at the S&P here together. So the S&P is up 20% off the lows. A lot of people consider that to be a new bull market. And I've been seeing people tweeting things like that today. Like if we go look at my profile and we look at the last tweet here that I retweeted this morning, this man here, Ryan Dietrich, not trying to blow him up, but this is his tweet, so we're going to use it. Once stocks are 20% off bear market lows, did you know a year later stocks have never been lower? That is actually flat out wrong. Let me show you. I made a chart this morning. It's the S&P from the tech bubble. Remember I was drawing comparisons to the tech bubble? In 2000, the S&P fell 30% from peak to trough in the first leg of the bear market, and then it rallied 21%. Then it fell again. Then it rallied 25%. Then it fell again, and it rallied 24%. And what do you know? In these two rallies, 1 year later, price was much lower. So what that guy said over here, once stocks are 20% off the lows, you know they've never been lower? Yes, they fucking have. Look at the chart. This man got 400 likes and 100,000 views for this. Now, I just pointed out because it's important that we don't just listen to what other people say, but that we actually go to the data and verify it ourselves. It's right there for the taking. Just go look. And there are people putting out all kinds of bullshit, peddling their bags, selling their biases, talking up their book in an effort to get engagement and to help drive narratives toward their preference. I am here to poo-poo that. A market being up 20% off the lows doesn't mean anything. They call it a bull market because the mainstream media needs something to talk about. And if we go back here and we look, I also tweeted about that this morning. Look, people just wake up and they have an alert set on their phones for when the S&P is up 20% off the lows, and they all tweet out that it's a bull market. All of them in unison. And then they clap themselves on the back for a job well done. They collect the engagement, and no one of the low information market participants is any the wiser. None of them elevates themselves. They just get hit with the same block-headed analysis again and again. These 20% rules are utterly meaningless. So let's just stop talking about them. And I will now. So we've got the S&P rising. If I look at the NASDAQ 100, which is just the top 100 stocks in the NASDAQ, it's even higher. It's above the 618. It's headed towards the all-powerful 702 retracement level. Some of you who follow me are also followers of the Fractal God King blockchain backer. He's a good buddy of mine. He is an XRP guy. I'm a Bitcoiner, and yet we are still friends. And he is a very big proponent of the retrace levels. I've taken some of my analysis and the way that I use these tools from him in that regard because I've seen how effective they are. And time again, this is the danger zone. It's where we are now. We have been driven there amidst very slow moving deterioration of the global economy. And this move was driven heavily by 6 or 7 names that said AI a whole lot in their recent earnings reports, creating this massive 37% dislocation from the equal weighted index. So just purely from a technicals perspective, the market looks very strong, but it also looks open for a correction. This kind of strong move rarely goes without a reaction in the other direction, at least down to here, right? That's the next level of support, at least back down to here to below 13.5. What would happen if we just suddenly plummeted down here? What would happen to the AI narrative? Would people stop tweeting about it? Would they stop talking about this is a new bull market? Just that one move right there? I bet they would. And in fact, if we go look at Nvidia, I drew this the other day. That looks like a Head and Shoulders. Maybe it's not a Head and Shoulders. We don't really know. We'll have to find out. But if it is, let's do a measured move on that Head and Shoulders. Let's say it breaks the neckline here. Where's it going to go? Retest of the prior all-time high. That would probably bring the NASDAQ down quite a bit, because this is part of the reason the NASDAQ went up in the first place. So I think we're in a precarious spot, and I don't think the Fed is going to come to the rescue anytime soon. All the talk over the last year and a half has been the big game of chicken between investors and Jerome Powell of the Federal Reserve. How high will he raise interest rates? How quickly will he get us there? How long will he keep rates where they are before being forced to cut? All of these dynamics are the source of endless debate. But what we have seen is that the strength of Jerome Powell was greater than the market expected. Because if you go back a year and a half, almost no one believed that the federal funds rate could get to 5%. And that's exactly where it is. I was in that camp. Last summer, I thought that they would have a hard time getting past 3.5%. They did. And in fact, they completely broke the paradigm. We set lower highs on interest rates for 40 years. And now we are about to test the high on federal funds from 2007. The Fed has raised 10 times since March of last year. And something that I think the market has kind of ignored, or maybe doesn't quite know how to factor into its valuations, is what the lag of policy is. Milton Friedman talked about this decades ago. There's been countless study done on this topic without a real clear answer to how long it takes for interest rate hikes to seep their way into the economy and start having effects. It's not immediate, Debt does not roll immediately. Interest rates don't immediately change the cost of capital for all businesses equally. Some of those businesses may not need to take out new debt for quite a while. They may have refinanced at lower rates and be relatively insulated. That's what happened to American homeowners. Many of them refinanced in 2020 and 2021 when the mortgage rate was a fraction of what it is today. Let's go look at the 30-year mortgage. Back here in 2020 and 2021, we had record refinancing back here. You have millions upon millions of American homeowners who just don't care that interest rates have gone this high, that mortgage rates have gone this high. It doesn't affect them in the slightest bit. I am one of those homeowners. I refinanced in 2021. My mortgage is 2.75%. I feel like a member of high society when I look at 6.8% mortgage rates right now. Absolutely affecting present and future housing demand and the ability of homeowners to buy the house they want. But for all the folks in a situation similar to mine, this just doesn't matter. So that's slowing down how long it takes for these interest rates to really get into the economy as far as the housing market is concerned. Think about other markets. Think about sovereign debts and corporate debts. Some of them have maturities of 2, 3, 5 years, which means they won't have to roll their debt until this year, next year, 2025. And it depends on what rates are at that point in time. And when you look back at the timeline this year, like if we go back to where the Fed started raising interest rates, it was not that long ago. It was 15 months ago. So even if we take a conservative estimate and we say that it's a year, most of the conventional wisdom is that it's 18 or maybe 24 months before interest rates really get their claws down into the economy, where they start affecting businesses' margins and things like that. If we just assume it was a 12-month window, well, then we are really about here in the hiking cycle. We have absorbed maybe 75 bips. Maybe if we're lucky, we've absorbed 150 of the 500 bips of raises since March of last year. All of this is still in the pipeline, friends, and we don't really know how it's going to affect things. So when I see people's earnings projections turning more positive in the last few weeks, when I see people's calls for the S&P later this year to be considerably higher than where they are today, I hope that they are right. Like, look, I would love for a number to go up. I have a 401k. I don't have a job now, but I still got a 401k. I would like those values to go higher. Sure, that'd be wonderful. I just don't know how likely it is for the market to continue climbing, completely ignorant to whatever is happening here in the economy. What makes that tricky to estimate is, like I said, the interest rate resilience of the economy. I mean, we printed $9 trillion in response to COVID. We sent American households $3 trillion of helicopter money that they did not have to pay back, at the same time that many of them were refinancing their homes at low mortgage rates. So you've got a bunch of people who don't care that rates went higher. They still are employed. We have 3.7% unemployment, which is a historical low. It's near the bottom of the long-term series. And we've got all these Americans that have more more money in their bank account today than they did in January of 2020. Now, it's not evenly distributed. There are some people who are experiencing a very different last couple of years. I am sensitive to that. But on a national average level, the consumer has more money today and is more insulated from interest rates than they have been in a long time. And you've got a Fed raising interest rates to try to slow down the consumer. And he's having a bitch of a time doing it. So I think we've still got some wood to chop here. There are a lot of factors in the air. We haven't really talked about inflation today. I haven't dove deep into employment, and we still need to talk about bear markets and recession risks. Those will be in upcoming videos. But today I really just wanted to fly through some charts, give you some high-level thoughts about different things going on in the market, and let you digest some of that while I come up with a way to present this massive database of bear market information that I've been putting together for the last 6 months. I got to figure out some way to tease it out for you so that it's not an overwhelming amount of information. But just to kind of give you a general sense of where my head is at, when you look at the yield curve, particularly the 3-month, 10-year Treasury yield curve, it is deeply inverted. It is the most inverted it has been since the 1980s. I have a different version of this chart right here. This is the same exact chart, but it's going back further in time. So the 3-month 10-year is deeply inverted. It's as inverted as it was back in 1981, 82. This was the Paul Volcker era, the double dip recession of the early 1980s. And every single time that the 3-month 10-year has inverted, going back to 1968, it has happened right before a recession. Even right here, you can barely see it, but there are a couple of little red boxes right here on my screen. It was a very mild inversion before the 1990 recession. So we are 100% accurate on 3-month 10-year inverting before recessions. We are currently deeply inverted, and I think that this is a clear-cut signal that we are likely to experience a recession before this saga is over with. I don't think that this time is different, but we'll save more of that discussion for next time. This video might be a bit of a whirlwind. I don't even know what it's going to look like when I get into editing. It might be 30 minutes of me just rambling. We'll have to see. But it's hard to come back from a 5-month hiatus and to give a succinct summary of everything that's going on in the markets. There are so many aspects we didn't even touch upon. We didn't talk about the Treasury bill issuance coming out this week and what that's going to do to yields. We didn't really talk about the regional banking situation very much at all. We haven't really talked about employment or inflation or really dove into what happens in recessions and what that looks like compared to today. We will do all of that in the next few videos, so make sure you are subscribed to my channel and you have the alerts turned on. I also recommend you follow me here on Twitter at TXMC Trades. This is my main account. I spend much of each of my days on here because I'm a degenerate and I love the markets, and this is where you will find me. I will try to get another video out in the next 36 hours, either tomorrow or maybe early on Wednesday. I've got to work through the process of how to present the next set of information, but we will put out another video, and then we'll just keep on going, friends. What I'd like to hear from you in the comments. First of all, if you have any questions for me at all, please leave them in the comments. I read and review all of them. Secondly, I want to hear from you if you have an opinion about whether you prefer live stream videos or these pre-edited videos. Pre-packaged videos take longer for me to produce, but they're quicker for you to consume because we don't have as much casual talk in between. But live streams have that interactive element to them. I'll be on the camera. We can talk about more freeform things. So be sure to leave some feedback in the comments if you have an opinion. If not, that's fine. And let me know if you'd like to see more live streams or you want me to stick with the pre-edited videos. And I'm also thinking about other things to maybe talk about on here. I do trade. Part of the reason I don't share a lot of my trades because I don't want people following me. I'm not an amazing trader, and I've had to kind of backburner it off and on the last couple years as personal and job things got in the way. But I do trade, and some people ask me about those things. So if you'd like me to occasionally post videos where I talk about my trading approach or things I'm looking at, let me know. I've always kind of avoided that on this channel, but maybe we throw some things at the wall and see what sticks. Also, some people like listening to me read from financial history. I like to read some newsletters, do kind of like an audible market study kind of thing. If you're into that, let me know too. We'll find out. I just want to get some feedback from you guys. It's been a few months. I'm trying to maybe experiment with some new things here and get this channel revived. So I want to hear from you what you find most interesting. And that is where we will leave it today, friends. I feel like I've talked for an hour. This recording, unedited, is 50 minutes long. I'm going to try to make that half as much for the video, but we'll find out. So until next time, please take care of yourselves, friends. I hope that you have plans for this summer. I hope that you're not spending all day watching CNBC and watching the degens on Twitter and just getting lost in the hype. There's so much misinformation going on right now. I have to just turn it off sometimes. And we will chat again either tomorrow or the next day. I promise you that. If you guys tell me you want it to be a live stream, if enough of you do, we'll do it live. Otherwise, I will pre-record it. That's it. I've talked too much. I'm going to let you go. I love you guys. Thanks for coming back to the channel after so many months. I'm hyped to be here. Let's go. Until next time, baby. Take care, friends. Cheers.